In the USA, there is one thing that is better than any of the report shows how the changed life. It is a loan, not a bet, no schedule, not statistics, and the role credit plays in a normal month the average person. In the 50s, credit looked like little magic. You buy today and pay later. Not because you lack, but because it's more convenient. Because it is a sign of trust. Because this is a new level of comfort, such as TV in the living room or the new appliances in the kitchen. And now look at 2026. The loan in the United States often no longer looks like comfort. It looks like oxygen, not as a way to make life more convenient, and as a way to make life possible at all without constant failure. And that this is a major paradox. Outwardly, everything else looks fine. People drive the cars, buy things, pay for services, go to the shops. But inside many families, this normality is not on stock and debt. The difference between these two worlds is huge, even if it is not always visible. Before the loan was the fact that you choose. It is increasingly becoming what you gently pushes the structure of costs. You don't take credit because I want to. You take the credit because the month have already been distributed in advance. And any little thing, repairs, insurance, medicine, breakage, turns not in irritation, and in the decision to migrate to close a minimum payment and what to leave for later. And here's the moment that changes everything. When later becomes permanent. When you don't say to yourself, I'm going to close this quickly. You start saying, the main thing is not to fall into arrears. An almost invisible psychological switch. But it turns out a loan from a tool on Wednesday. And then the question arises that cannot be solved by one counsel about the budget. How is it that a country that when we came up with a loan as a symbol of amenities, now increasingly using it as a support system for daily life? And what it says about where the U.S. on. The key thing that you need to understand immediately. The loan in the United States are not corrupted in a single day. It was not bad because someone was stupid. He just changed the role. In the 50s, the loan was an add-on to a sustainable life. In 2026, credit for millions of families became part of the floor on which they walk every day. Then the loan was a story about trust and convenience. It is often the story of compensation for what is missing. Margin, stock, peace of mind. And so it was clear no abstractions. Just look at how changing one and the same scene in the human head. In the 50s, buy now, pay later sounded like a small civilization. You weren't afraid of the later because you had a feeling that tomorrow will be like today. Wages, cost of living, expectations, everything was more predictable. Even if it was crowded, people felt the movement. The world looked like stairs. Do not have rapid growth, but growth is possible. In 2026, the problem is that the ladder was slippery, and when you're not sure of the next step, you don't want to make commitments. But at the same time, you are living in a system where commitments themselves, insurance, rent, car, utilities, and medicine. The payment asks you not in the mood, he comes in. And here, credit is not a choice, but a buffer. Because if you have gone the margin, any extra waste ceases to be superfluous. She becomes what breaks a month, and in this moment ceases to be a way to pay for dinner. It becomes a way to close the gap between reality and the schedule of payments. The most treacherous moment comes when the person ceases to receive the loan as a debt that must be returned, and begins to perceive it as part of a monthly cycle. It sounds harsh, but it's like breathing. You have made the payment, has become easier. Once again, you're wasted, because otherwise it does not work. Again, you made a payment, not to be broken. And so the circle closes. This system is well masked by the fact that apparently true that life goes on. People have purchase, deliver. There is a reason. There are things that resemble a normal life. But the difference is that in this increasingly normality there is no stock. So any impact becomes louder, and it changes behavior more than any slogan. To understand how this differs from the 50s, I must see this one simple thing. Previously, the credit was expanded opportunities. It as often retains the basic level. These are two different economies. One economy growth, a different economy retention. And that is why it is important not only for individuals, because when a loan is a massive containment system, changing the structure of demand. Shops, services, and even the housing market see not just buyers. They see people who pay parts and live by the principle, only a month has passed without failure. From the outside, it may look like sustainability. The sales are, services order, restaurants are empty. But within this, resistance can stay on duty, not in the real sense of freedom. And the system becomes more sensitive to every crack. Because if the demand is supported by the loan, any tightening or height minimum payments can drastically cut everyday expenses. Now, let's look at why it's become so massive. Because the brain always wants to find a reason. But there is no one. There are several threads that have developed together and reinforced each other. The first thread is the disappearance of margins in households. You can be a working person, you may not even consider themselves poor, but if you have the end of the month remain zero, do you live without a shock absorber? And then the loan becomes an attenuator instead of savings. The second stream is the structure of mandatory spending. In 2026, many expenses are similar to subscription for survival. You can't just not pay. You need to go. You need to be insured. You need to live in housing where the price is growing faster than the sensations of tranquility. You need to be treated, even if you don't want to think about prices. In this system, the loan becomes a way to mitigate is not a luxury, and liabilities. The third stream is psychological fatigue. When life requires constant adjustment, a person begins to save not only money, but also energy. It transfers decisions. It delays canceling subscriptions. He endures. He chooses the fastest option, even if it is more expensive, because it doesn't have the energy to optimize. And the paradox is that this is what makes debt more sustainable, not because people love debt, but because they are too tired to build a perfect system without it. The fourth stream is how credit is sold culturally. It's still being sold as freedom, as a convenience, like you deserve it. But for many, in practice, it turns into a paid delay of the alarm. You're not solving the problem. You carry it, and you transfer it at an interest rate. And here is the most dangerous place in all of history: minimum payment. Because the minimum payment doesn't look like a disaster. It looks like a compromise, like a small solution to exhale. But it is he who changes a person's relationship with the future. It tells you that the future now has to pay for today's month. First, it's one time, then two. Then it becomes a habit. And then there is a thought that sounds almost the same in different people. The main thing is that there is no delay. This thought puts the person in debt service mode. And when there are a lot of such people, the economy begins to work differently. Because the economy is not just about numbers. These are mass habits. When millions of people live in maintenance mode, they take fewer risks. They move less. They change jobs less. They are less likely to launch new projects. They spend less on things that improve their lives and spend more on things that keep them going. And this is where credit becomes infrastructure. It penetrates everything. The way people buy their groceries, the way they fix cars, how they survive medical expenses, how they pay for insurance. And then the conversation about credit ceases to be a conversation about financial literacy. It becomes a conversation about how everyday life works in the country. There is one indicator that is particularly good at explaining the difference between comfort and survival. This is what people take out a loan for. When credit is used for large, rare purchases, that's one thing. When credit is used for basic things, it's different. And in 2026, the wake-up call is precisely that debt is increasingly covering everyday spending, not just big plans. And that's why it's easy to connect it with your two-speed line. In rich areas, credit can remain a convenience. There, it is an optimization tool. There, people pay and close. There's a supply there. In other zones, credit becomes a crutch. There, it supports the month. There, it replaces the margin. And this makes the difference between the districts even more noticeable. Because where people have a reserve, they continue to live as if the world is still predictable. They buy the service. They buy convenience. They buy time. They create demand that keeps the business around. And where there is no stock, people buy only necessity. And if the need is increasingly closed by a loan, the area begins not just to get poorer. It starts to wear out. The most interesting thing is that it doesn't look like a crash. It looks like a habit, like debt normalization, and as long as this normalizes, the country may look resilient. But inside it becomes more fragile because sustainability is based on the fact that the future constantly pays for the present. If the loan has become an infrastructure, then the question arises. What happens when this infrastructure becomes more expensive or starts to fail? What happens when insurance raises the payment, when the card rate increases, when the limit is cut, when the bank changes the terms? What happens when the buffer suddenly disappears? The first line is a car, because in the United States the car is not a choice for millions of people, but a condition of life. Work, school, shop, doctor, everything is kept on wheels. And that's why auto credit and auto expenses have become one of the fastest ways to turn a normal life into a permanent service. At first, everything looks decent. You have a payment, you have insurance, you have gas, you're holding up. Then comes what always looks like a small thing until it adds up to a punch. Tires, brakes, battery, sensor, lamp. What used to be an annoyance is now becoming a solution. Because this is no longer a question of fix, but a question of when. And if you choose later, you pay more in either money or risk. And here the credit card enters the frame almost automatically. Not because you want to live in debt, but because you don't have another buffer. And this is a very insidious moment. You tell yourself it's only temporary, that you're going to close the renovation now and then pay it back next month. But the next month brings other payments, and in the end the debt remains, and the car again requires attention. Then a second level of wear occurs. Not only financially, but also psychologically. People start driving more carefully not because they care about the car, but because they are afraid of breaking down. They are afraid that they will have to pay right now, and this feeling gradually creeps into everyday life. You start planning your route so that you don't have to take any risks. You're delaying your trips. You shorten your life to reduce the chance of spending. The second line is medicine, and here you don't even need to take extreme cases. Sometimes just one regular session is enough, which turns into a chain. Analysis, additional examination, another session, an invoice that comes later, which is why it looks like a trap. Because you can't opt out anymore. This has already happened. In the 50s, the main concern was that medicine could be expensive. In 2026, the alarm is different. That the bill can arrive when you already have no air in the budget. And that's why people start putting off even what they need. Not because they don't understand the importance, but because they understand the risk. The risk that a single session will ruin a month. Once again, the credit card becomes a bridge between I must and I can't right now. At first, it looks like a one-time thing. Then, as a habit, and then comes the most dangerous thought. If I don't go, it will be worse. If I go, I will get a bill that I can't handle. This is the moment when debt becomes part of the infrastructure of life. It serves not comfort, but health. And the third line is insurance. Because insurance seems like something that should protect. But during such periods, it is increasingly felt as another payment that grows regardless of your will. Auto insurance, housing, medical care, all this can be raised so that a person does not even understand what exactly has changed. You haven't improved your life. You didn't get any more. But the cost of being in the system has become higher. And here comes a scene that is very strong on the screen. Notification of renewal. The new payment is slightly higher. Not twice, not a disaster, just higher, but in a system without margin. Just higher is no longer a small thing. This is a shift. This means that somewhere you need to cut back, or somewhere you need to close the hole. And here's what happens next. People start doing things that would seem strange in normal years. They raise the deductible to lower the payment. That is, they buy the illusion of stability now at the price of a bigger hit later. They take out worse insurance. They delay maintenance. They start living as if they hope nothing will happen, because if it happens, they won't pull it off. This makes the country a paradoxical construct. Officially, you have insurance. You have a loan. You have a job to do. You have a car. Everything works, but inside the system becomes thin, because it is not based on the stock, but on luck. On the fact that this month will pass without surprises. The economy becomes not an economy of growth, but an economy of no mistakes. When a person lives without a margin, they can't afford to make a mistake. And in 2026, a mistake is not only a bad decision. A mistake is just life. That's why people become more tense. Not because they are weak, but because the system forces them to be constantly accurate. And this changes everything, even if the unemployment rate looks acceptable, and even if the statistics say, on average, normal. When credit becomes a buffer, demand becomes more fragile. People continue to buy, but they buy with a delay, with installments, with the feeling that they are taking from the future. And if the future becomes more difficult, purchases begin to disappear not one at a time, but in bundles. And that's why shops, services, and cafes are closing. Not because everyone suddenly didn't like it, but because the very little freedom that creates impulse spending disappears. Coffee on the way, quick dinner, minor repairs, gift. All this is held on margin, and when the margin disappears, millions of small yeses disappear. There are only yeses left to say: rent, insurance, the car, meal. Everything else becomes a question. And this is where credit ceases to be just a financial product. It starts to change the geography of the country. Areas where people can still buy convenience stores are getting brighter. The service is saved there. Business remains there. There's more speed. And the areas where people buy only necessities are getting quieter. There are more empty storefronts. There's less work nearby. There's more fatigue. Credit in such a system is not just a personal problem. This is a public indicator. It shows how many people live without margins. And if you want to understand why the country feels more nervous, more irritated, more divided, look beyond politics. Look at how many people live on the verge of making mistakes. Because when millions of people can't afford to make a mistake, they become more cautious. They hold on to their work. They move less. They take less risks. They plan less. And this turns the economy into a slowing organism. He's alive on the outside, but it moves worse. The most dangerous thing is not that debt exists. The most dangerous thing is that debt has become a way to maintain a semblance of normalcy. And if this visibility breaks, the effect will not be a point effect. It will be chained. Because when the buffer is the same for many people, the impact occurs simultaneously for many. There's one thing that people almost never notice right away. When a system becomes fragile, it doesn't scream. It changes the interface. Not the prices in the window, but the conditions at the bottom in small print. Not headlines, but decisions that are made without emotion and without explanation. And the first to do this are those who live at risk. Banks, insurers, and credit services. They don't wait until things get bad. They respond to signals earlier, because their business is not about how everyone lives. Their business is about who will break first and how much it will cost. Here's a scene that many recognize but rarely associate with the economy. You open the credit cards app and see that the available limit has become smaller. You didn't do anything. You didn't miss any payments. You didn't change jobs. The limit just got lower. Or the interest rate has become higher. Or a new commission has been added. Or the bank started sending strange offers that look like a concern, but sound like a lifeline. And at this point, the person has a thought that usually comes late, so they know something. so they see the picture differently. Because when households lose their margins, this is not a philosophy for the bank. This is the mathematics of probabilities. If the customer has less headroom, they become more sensitive to any impact. And if there are millions of such clients, the system begins to behave like an organism that strains in advance before hitting. Shrinks, removes weaknesses, reduces risks. And this is what this compression looks like in practice. It almost always starts with 3 quiet steps. The first step is limits and rules. Banks are becoming more careful with those who previously received loans automatically. Not because the person is bad, but because the environment has become worse. The system became nervous, and they begin to reduce the probability of losses in advance. Fewer approvals, higher requirements, more checks, less easy money. The second step is the cost of debt. Interest and commissions become what the system pays for fear. When risk increases, the price of risk also increases. And for the average person, this turns into a trap. You use a credit card to cover the hole, but the credit card gets more expensive just when you need more air. The third step is the most unpleasant. It is almost never discussed out loud. This is a change in behavior towards good customers. Because in normal times, banks try to hold back those who pay. In nervous times, banks try to keep those who will definitely pay. And these are different groups. You can be a normal, neat person, but if your profile looks a little more fragile, the system starts to lead you to a different category. A little less trust, a little more insurance, slightly more requirements. Because a credit card in 2026 is not just plastic, this is a daily buffer. This is a soft pad between income and expenses. When this buffer becomes less available or more expensive, some people instantly change their behavior. They reduce spending. They postpone decisions. They stop supporting the optional economy. And here we are again, back to the streets, to the storefronts, to the services. But the most powerful thing in this story is not happening at the banks. The worst happens with insurers, because insurance is something that people are willing to spend almost nothing on. They'd rather cut back on entertainment than lose their insurance. And that is why the insurance market is becoming the best indicator of how fragile a society has become. And here begins what can be called insurance meltdown, without panic, but with clarity. The first thing people feel is an increase in payments. Not dramatic, but regular. And that's worse than one big jump, because a big leap is perceived as an event, and regular small increases are perceived as the new normal. They erase the margin month after month. The second thing that people feel is a change in conditions. Increase in the deductible. Narrowing of coverage, longer consideration, more document requirements, more reasons to say this is not covered. And it's not because insurers are suddenly angry. This is because they are rebuilding the model for a more risky environment. They are trying to survive in a world where losses grow faster than premiums. The third thing that people feel is the most toxic. It's the feeling of being quietly pushed out, not with a "we don't insure you" email, and the fact that the price becomes so high that you leave yourself, or the fact that the update comes with such a payment that you say, "I won't pull it," or the fact that in a new place you are given conditions that cannot be fulfilled quickly. And that's why it looks like they're quietly leaving you, because in the bureaucratic sense, the system works. You can find insurance, you can arrange something, but the price and conditions make it less and less realistic for the average family. Because insurance meltdown in 2026 is not a story about one hurricane, one fire, or one big news story. This is a story about the fact that predictability has become paid. And the price of this predictability is growing faster than people can get used to. When insurance becomes more expensive regularly, it ceases to be a protection and becomes another mandatory life tax. When conditions are narrowed, you pay more, but you feel less protected. When you are pushed out by the price, it does not look like a refusal, but it feels like an exception to normal life. And the most unpleasant thing here is that it changes behavior not through fear, but through fatigue. People are starting to live more cautiously. They stop planning big moves. They postpone repairs because it's still holding up. They are delaying the replacement of the car. They hold on to their work not out of desire but out of necessity. They reduce spending not because they want to, but because it won't work out otherwise. And then the system starts to look new even on the street. You see less traffic, fewer extra U purchases, fewer small businesses that lived on impulses, more for lease signs. There are more places where the lights are dimmer, not because the electricity has been cut off, but because life has become more cautious. And here's the main conclusion of this video. The insurance crisis is not a separate issue. This is a mechanism that accelerates two U.S. speeds. Where people can pay for security, neighborhoods become even more secure and even more expensive. Where there is no margin, any increase in payment turns into a choice, and any choice turns into a contraction of life. And that is why all this is dangerous not as an event, but as a process. Because when millions of people are living without a supply, the country doesn't need a big hit to start a chain reaction. A series of small ones is enough. If you want to understand how fragile the system has become, don't look at loud statements. Look at what becomes mandatory and unavailable at the same time. Insurance is a perfect example. Write in the comments what you see here. Home, auto, or health insurance has grown the most. And do you feel that the conditions have become worse, even if you pay more? And if you want a sequel, the next part will be even tougher and more specific. We will analyze why insurers and banks essentially rewrite the U.S. map without laws and elections. Through tariffs, through restrictions, through which areas are becoming should insured, and which are gradually turning into a high-risk zone.